I'm sure by now most of you have heard of the new leverage restrictions that are coming to CFDs and spread betting courtesy of ESMA. But what does that mean for retail traders? What are the differences going to be? And does it mean the death of retail traders, especially beginner traders? Well, let's have a look. Okay, so ESMA, the European Securities and Markets Authority. I'm sure over the last few months you have all received sort of panicked emails from your brokers, first of all asking you to email ESMA and try and stop them from pushing through the new regulations. And then after that failed, you probably got emails from your broker explaining what the new leverage regulations are going to mean. In terms of the changes, I would say it's pretty much the largest change to spread betting and CFDs, certainly that I can remember. So since we had easy access to the internet and everyone's been able to get onto the markets, you know, the boom of the retail traders, I would say since then, these new leverage changes are going to be the biggest change to the industry. Now, at present, you can join a broker and you can get leverage of, you can get some crazy leverages. You can get sort of 1 to 200, 1 to 300, even all the way up to 1 to 500. So when you see these brokers offering you to trade at sort of 10p per point, very often they're using 1 to 500 leverage. And it enables you to trade with such small quantities of money. Now, when the new regulations come in at the end of July or into August, they're going to be very different. So at present, what we are hearing is that for Forex markets, maximum leverage is going to be 1 to 30. For indices, it's going to be 1 to 20. And for crypto markets, it's only going to be a maximum of 1 to 2. So what do those numbers actually mean? Well, the first thing it means is for the vast majority of retail traders who are beginners, you're not really going to be able to trade the way that most of you have been trading. Now, there's sort of benefits and drawbacks to what is coming in. The first thing is with the drawbacks, it is going to completely change the trading industry for beginner retail traders. It's going to sort of like take it out of the reach of a lot of people who can't really afford to fund their account with these new leverage restrictions. Personally, I don't agree with it. It's just another case of the EU sticking their nose in really where it's not wanted. You know, if you're a fully grown adult, you should be able to decide exactly what you do with your own money. But regardless of that and regardless of all the emails that were sent to them, they have gone ahead with the changes. And really, it is actually going to protect a pretty large segment of people who come to trading also. Now, let's look at one of the examples, or the most recent example that I got emailed by a broker. And I'll sort of break it down and we'll look at what exactly it means, and I'll clear up one of the most common misconceptions that I seem to deal with when it comes to sort of leverage and margin. So we're going to look at an index. The index is the DAX. So the DAX is the German index. At present, with most brokers, you can sort of go in and if you're going to trade the DAX at £1 per point, you need £54 of margin. So it's a relatively small amount of margin to be in your account. Now, when the changes come in, that is going to go up by 10 times. So to trade £1 per point on the DAX, you're going to have £540 of margin. And it's pretty much going to be the same amount across Forex and indexes, sort of depending where the markets are sitting. Now, one of the most common misconceptions that we need to clear up, first of all, is in terms of margin. What is margin? So the first thing is, margin does not equate to your risk in a trade. So people sort of see these numbers and they get a little bit panicked and they think, I don't want to risk £540 on a trade. Your margin is like, if you think about buying a house, when you go to buy a house, you usually put down a deposit of sort of 10 to 20%, and then the bank lends you the remainder of the money so you can have the house. It's a very similar thing when you are trading. Margin is the equivalent of your deposit. It has to stay in your account. It shows that you can afford to fund the trade. So right now, with those 1 to 200 leverage, 1 to 300 leverage, the margin requirements are very low. But after the new ESMA regulations come in, they're going to be a lot higher. So to take a trade on DAX, you're going to have a minimum of £540 in your account. Now, if you lose your trade, that doesn't then mean you're going to lose £540. That's just your margin. So if you go into the trade and you've got, let's say, a 20-point stop at £1 per point, if you lose that trade, you're going to lose £20. You're not going to lose the 540. That's sort of the most common thing that I hear. People sort of panic when they see these big numbers and they think, I'm not going to be able to trade because I can't afford to take £540 trades. So leverage and margin, they sort of intertwine and they become your deposit if you were buying a house. Now, what it is going to mean is that for the vast majority of retail traders at present, what I tend to find is that they come to the markets and they sort of put in, £100, £200 into their accounts, and then they start to play about with the charts. With £1 per point at present, you only need £54 of margin. That's no longer going to be possible. You're basically going to have to trade on a demo account, and then when you're ready to trade live, you're going to have to fund your account with a minimum of £540. And really the £540 is the base amount that you're going to need in your account, because if you have to have £540 margin, you need to then have money on top of that to risk on your trades. Now, who is this going to affect most? Well, first of all, it's going to affect those retail traders that I was just talking about. The people who don't really know if they want to trade yet, they just want to come, put in £100, put in £200 and sort of play about on the markets. It's going to be completely gone. And the only avenue for those traders is either a demo account, which is still good and it's also a safe way to learn, or they're going to have to find some unregulated broker who I really don't advise you use, because an unregulated broker, there's nothing to say they're not manipulating the markets, and there's no protection on your money. If they decide to go bust, if they decide to close their doors, you've got no way of getting your money out, unless they just happen to be an honest company. So first of all, retail traders, it's really going to affect the beginners with a relatively small account. It's also going to affect people who take multiple trades at once, or people who have very, very large stops on their trades. Because if you think about it, if you have £540 margin for your position, and at present, let's say you're taking 5, 6, 7 trades at once across markets, and really I'm thinking of sort of the long-term swing traders, the people who take positions on lots of different Forex markets, and maybe they've got 10 positions open at once. That's going to become incredibly difficult to do unless you have got a very large trading account. Who is it not going to affect so much? Well, it's a couple of people. Day traders, less so. The reason it's not going to affect day traders as much is because as a day trader, we tend to have fewer positions open at once. I only really have one maximum of 2 positions open, so it's not going to drastically increase the margin I have to have available, because I've not got 7, 8, 9, 10 positions open at once. I don't need to have all of those deposits for my house in the bank account. It's also not going to affect people who use good risk management, and again, this should really be everyone. And what I think these proposals are doing, it's sort of a hammer trying to put in a pin. It's an overreach by ESMA trying to stop people from basically gambling away their money. When you come to trading, it's very well known that you should really only be risking sort of 1% to 2% of your trading account on any one trade. Now, what actually happens is that most people, they come and they risk much higher, especially if you're only depositing sort of £200 to your account. You come in and you risk, even if you're risking £50, it's 25% of your £200 account. And what happens is, as you learn to trade, for a lot of people, they start to blow their accounts and they start to refund their accounts. And they start to sort of bulk their account up, because what tends to happen in the mind is you start to think, the reason I'm not winning is because I'm not risking enough. I need to sort of be risking real amounts of money. When I'm risking real amounts of money, then I'll know what it feels like to have a loss properly, I'll care more about my positions, and I'll trade more carefully. It sounds crazy, but that is what most people do. And all that happens is their losses start to increase. And for a lot of people, they get themselves into a lot of debt. It's really not helped by the whole sort of trading industry, which focuses on the fast cash, the huge wins, the huge losses, the Ferraris, the watches, all that sort of nonsense. And on top of that, on top of the ESMA proposals, all of that type of advertising is also being banned by Google, Facebook, and Twitter, which is a really good thing. I don't have any negative to say about that. But if you are serious about learning to trade, first of all, it's going to be more difficult in terms of the deposit you have to put in your account to start trading. Now that money is still yours, the margin. You can take that margin out whenever you want, but you're going to have that larger sort of foundation before you can then start to build your trading off of it. But if you are serious about trading, and this is why I sort of lean towards it also being a slightly good thing. If you're serious about trading, you really want to approach this like a business, and you really have to have a definite commitment to what you're doing. And by putting that money into your trading account, it sort of helps you focus the mind, because you know it's not putting £100 in or £200 in that you're just scalping off of your wage at the end of the month, and then you're just playing about with it and losing the money. It's going to take some serious thought, because it's more of an investment. And if you are serious about trading also, then it shouldn't really matter that your risk on trades is going to have to reduce quite significantly to 1% or 2% per trade, because if you're serious about trading, you should be following professional guidelines, and the professional guidelines are always, first and foremost, protect your trading account. And you do that by risking small and by having a well-structured trading plan, which is not only aimed at finding winners, but aimed at protecting your account when you start to have those losses. So really big changes coming to trading. I'm really interested to hear your guys' thoughts on this, if you agree with it, if you disagree with the ESMA proposals, also if it's going to affect your trading. If you're using, very large stops, if you're used to having multiple positions open at once, what are you going to do to combat that? Because I'm really interested to hear from other traders and see exactly what they are planning to do, and if it's even going to scare you away from trading completely and you're just going to close up shop and say, okay, that's fine, trading is just not for me. Okay guys, that's pretty much everything for this video. The only last thing to add is, if you are interested, you can always pop across to decisivetrading.info. There is a free introduction to trading course sitting on the website. There's also a free Decisive package, which gives you seminars and then can help you move on to a professional trading course. Again, it's absolutely free. So that's everything for me today. As always, I hope that was helpful. I'm James Orr, and thank you.